Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning, and if you were thinking that maybe as we wind down the week, things are going to get a little slower with all the earnings madness, well, it's not. It's getting quicker. It's getting fast-paced. And news has been at a frenetic pace since last evening. We're coming to you from the CNBC-TV18 Motilal Oswal studios. There is the FOMC, which is a non-event. There are tariffs and there are earnings. I'm Prashant Surbi. Nigel with me. Guys, good morning.
Guys, good morning. 25 is the new number. Yeah. That seems to be our number. Let's see how we'll digest it.
Well, indeed, and add to all the cues that Prashant stated, today is the monthly expiry as well. So add to the volatility. We've got some green on the screen. That's Prashant. Let's see whether or not there is some pullback, because otherwise it could be a pretty much a red-looking screen to kickstart trade. But don't rule out a bounce back. Let's see. Let's see how it goes.
Can you guys make out on air that it's green?
Yeah. It's
maybe
there. The eye, everything. It's the biggest support the bulls can hope for, at least at the start.
You know, so all of us know that the 25% tariff has been announced on Indian exports to the US. But then there is a soundbite as well, which I think is important to note. Actually, it's very important to note, because the soundbite which we will play now suggests that, you know, there is still room for negotiation, talks, and this is President Trump himself indicating that, well, we will decide by the end of the week. That's essentially tentatively where he left off. Listen in.
Well, we're negotiating right now, and it's also BRICS. You know, they have BRICS, which is basically a group of countries that are anti the United States, and India is a member of that, if you can believe it. It's an attack on the dollar, and we're not going to let anybody attack the dollar. So it's partially BRICS, and it's partially the trade situation. It's the deficit. We had a tremendous deficit. So, as you know, Prime Minister Modi is a friend of mine, but they don't do very much business in terms of business with us. They sell a lot to us, but we don't buy from them. You know why? Because the tariff is so high. They have one of the highest tariffs in the world. Now they're willing to cut it very substantially, but we'll see what happens. We're talking to India now. We'll see what happens. It doesn't matter too much whether we have a deal or whether we charge them a certain tariff, but you'll know at the end of this week. August 1st is a very big day for this country, because money is going to pour into the United States like we've never seen before.
Okay, well, the tariffs are here, and this is essentially what I want to start with. The simple table, I think, is the crux of why this feels bad, right? You know, 25% is what President Trump is saying that Indian exports will be hit with in terms of tariffs. Plus, there is an unspecified penalty for buying oil from Russia and military equipment, which we've done for decades from Russia. Now, that unspecified, forget it. We don't know what that is. Maybe it's just a threat, you know, sort of being dangled to bring India down to what President Trump wants to. We don't know if it may materialize as well. Let's just work with what we know, 25%. And the reason why I'm saying the 25%, of course, and we'll sort of, you know, discuss this in greater detail, impact to the economy expressed as a percentage of GDP could be between 0.2 to 0.5%. These numbers are not new. You know, in April, when President Trump in that White House garden, handed out tariff rates to countries, it was 26% for India. So these estimates were calculated back then. And now it is 25%. So that number is surprising, but it's not a shocker. But I think where the disappointment comes in is that when we started all of this in March and April, the expectation, the real expectation in India was that we will actually have a competitive advantage. We will be able to leapfrog by making a good deal with the US and be able to sell to the largest consumer market in the world, which is the United States of America. And we'll be able to sort of, you know, negotiate a lower tariff rate while selling into the US as compared to Asian peers, as compared to even some of the Western countries, et cetera, et cetera. That has not happened, and I think that is the disappointment here. So just look at this. India, 25% plus penalty. Forget the penalty for now. And look at the other rates. I mean, I think I don't need to sort of explain this. EU 15, South Korea, I think, has come out this morning, right? 15%, Vietnam, Philippines, Indonesia, Japan. And if you remember, President Trump and his first term, China plus one was a big theme back then as well. But back then, it was Vietnam, Cambodia, etc., which emerged as winners out of that 4-year President Trump's first term. And expectation was that we will sort of get our foot in the door as well. We still may. This is still, what has been issued on Truth Social. Let's move along. There is no letter which has been sent out. There is no executive order yet. You heard that soundbite from President Trump, which says that, we will know by the end of the week, and we are still talking to them. There is that bilateral trade agreement which we are negotiating, which seems to be in an advanced stage. But at this point in time, I think that is the disappointment which we'll have to sort of contend with. The Indian government officials' response has been very clear that they will not compromise. We will not compromise on sectors like agriculture, etc. And I'm only sort of putting this out because the statement makes it very clear that, we're not going to back off and we're not going to give in terms of open access to agriculture, etc. So that's the tariff bit that I want to put out. And of course, we'll get you lots of opinion as we go along. But prima facie, near term, this is, of course, can't be read as positive unless something quickly is negotiated. Now, markets, of course, on the FOMC front, read the decision as hawkish. The commentary is hawkish. I mean, actually, Chair Powell did not say this or that. He said we'll be data dependent, which the Fed always is. The market, though, was perhaps hoping for an explicit direction from the Fed that September there is a cut coming, which was not the case. And hence, if you look at market pricing, about 10 basis points of cut has been removed from the pricing for 2025. Market reaction is on your screen. The 10-year was up. You had the dollar, which is almost back at 100. Oil prices are at about 74. Very quickly, they've moved up over the last 3 days or so, 1.5% higher. Equities were flat. Post-close, Microsoft and Meta both reported solid earnings beats. And, this is the other story, the AI story, 8% after hours in Microsoft. The Meta stock up 10% after hours. So just the levels, right? Just putting the levels together. For the nifty, the low that we saw day before yesterday, 24,598 is in focus. Will we break it? Right at the word go, will we sort of close below it? If that goes, the 24,450, 24,500 levels come into sharp focus once again. Resistance, the 40-hourly exponential average, 24,877, and the 40-day exponential moving average, which is 25,005 on the upside. For the Nifty Bank, the low, similarly, is 55,843, which is a support. If that goes, the 13th of June low is 55,149, and resistance is at the 40-hourly exponential average, 56,405. GIFT Nifty will give you a quick sense of how we're likely to start. 200-odd points lower, so wham bam, straight up is what the indication is at this point in time. Surabhi.
Absolutely. So the thing is, and I guess Prashant, Nigel, you'd concur that for the market, in terms of market capitalization, sectors like textile are not that big. Pharma, of course, is, but for now, pharma has been exempt. But this is a sentiment blow, and it's coming at a really, really bad time. The timing is really off for the market. And obviously, in terms of GDP, and in terms of the real economy, this is an issue. So just to put the numbers in perspective, the US has been India's largest trading partner for the last 4 consecutive years. The value of US-India trade is a little over $130 billion. And we continue to run a big trade surplus with the US, which is in excess of $40 billion. So that's why this is really important. Now, India reacted. Let's just quickly put out the Commerce Ministry statement on the screen. We reacted by saying that India is committed on concluding a fair, balanced and mutually beneficial bilateral trade agreement. And the government attaches utmost importance to protecting and promoting welfare of farmers, entrepreneurs and MSMEs. It's a strong sort of, it's not a pushback, but it's a very clear indication of India's stance that we're not backing down, at least not from the looks of it. There's a commentary coming in from Kevin Hesed. So is there something, so there's the post, but are the back channels indicating that there could still, be some sort of an arrangement in the next couple of hours? Let's hear out what Kevin Hesed, the economic advisor to the White House, had to say. He talks about how Trump is frustrated with the pace of trade talks with India.
Their tariffs have been so high on us that there's not a heck of a lot of trade. That's right. Well, it's a very asymmetric situation. I think that we're hopeful that India will open up its markets to us. That's the really big headline, I think, of the EU deal and as the Japan deal and the other deals in Asia is that they're opening their markets up to our farmers, to our producers, to our small businessmen who can now sell their stuff there without lots of red tape. And if we could do that in India, that would be an absolute game changer for the global economy because it's such a large and growing economy.
Okay, so that's as far as the big headline is concerned. Now let's look at Asian markets, and things are a little mixed out there. Cautious trade happening, though of course the big headline comes in from South Korea, with the South Korea also getting that 15% tariff deal. But markets are a little all over the place. In the Hang Seng, the Chinese markets are under pressure because the numbers that have just come out on the manufacturing PMI side, they're weak. There's contraction in Chinese manufacturing PMI. Now and there's the Bank of Japan meeting as well, by the way, which is also going to be important to watch. No change in rates expected from the BOJ. Now for the Indian market, we're dealing with three-pronged woes. There's obviously the trade deal blow that's come in this morning. There is a continued slowdown in earnings, and there is consistent FPI selling. So it's sort of an unholy trinity of sorts that's kind of come together. Speaking of FPI selling, yesterday's number, net sell of about 850 crores. So that's what we saw yesterday. Domestic institutions offset that. Plenty of DII buying, 1900. But the impetus of FPI selling has accelerated in July. In the month of July, we have seen 17,600 crores of selling happen so far in 31 days of July. Let's talk about earnings. I mean, though that will be sort of for the second and third gear today, once we get over the opening perhaps gap down. M&M pretty solid. You can maybe quibble on the margins. Margins have fallen 100 basis points. That's more than expected. We'll see. Tata Steel, Nigel tells us, is a pretty strong set, so no problems over there. Interglobe Aviation, the revenue, EBITDA, etc., they're below the pole. The weakness was anyway expected. It was a tough first quarter, but it's slightly below pole. And unfortunately, Hitachi Energy from that entire space, remember GE, Vernova, T&D's numbers were so good, but Hitachi has not been able to follow that up. So we'll see how the market reacts to this. But there's a silver lining, and the silver lining came in from Shireen's conversation with Mr. Salil Parekh of Infosys yesterday. The conversation was just after market hours, and the big takeaway is that Infosys is not giving any indication, at least right now, that it's looking at cutting jobs. In fact, he's saying that AI is opening up new revenue streams for the company. So no fresh negative seems to be the positive. And let's see if money gravitates towards IT, given the market environment that we'll see today. Nigel.
To add to the excitement today, we have the monthly expiry that will play out. And the big question is, can the bulls defend that 24,550 to around 25,000, which will be the series low, but you'll want it to defend that 24,550 to around 24,600 odd mark. But the Trump shocker definitely is disappointing. You can't slice and dice it anyway. Whichever way you look at it, it's disappointing because India was expecting a favorable outcome. But of late, you saw pressure in the markets. And yesterday, it seemed like, the street was sensing there is going to be some news that's going to be coming in there. Because the rupee, well, that weekend, it fell close to around 70 paise in trade. It ended closer to the low point of the day. If you look at the equity markets as well, there's been an underperformance. Compare the Nifty with the Chinese market, the emerging market, the Dow Jones. India has been a relative underperformer in the last 1 month or so. So that's telling you that, maybe the street was sensing there is going to be some bad news. And finally, the FIs, the flows in the cash market have been very, very subdued. And they've added shorts. In fact, from the start of the series, the net short positions are up by close to around 5 times to around 1.7 lakh contracts. Moving to what they did yesterday, no prizes for guessing. They added shorts yet again. Short positioning at around 86% or thereabouts. And from the start of the series, the FI net short positions have gone up by nearly around 5 times. Even the client long positioning has gone up multiple times. So that's normally a combination that we look at. Clients normally get it right. FI is net short in the system. That's not such a bad thing, but we'll have to see whether or not they cover out. So today, given that it's a monthly and weekly expiry as well, we'll have a fair bit of volatility. But there's plenty of action actually in this series because the rollovers are relatively lower, both on the Nifty as well as the Nifty Bank. On average, the Nifty rollover getting into the expiry day is around 70 to 73%. So there's plenty of action still left in this series itself. Moving to the options data, 24,900 call as well as put were fairly active. These option writers, who were playing a strategy out there, they were hoping that the 24,700 odd mark does hold out. For the time being, the GIFT Nifty is suggesting that we start below that level. So it'll be important to see where we end. But you don't want the recent low to get breached. So support comes in at this mark of around 24,599, 24,550, 24,599. And resistance comes in at around 24,950, going by the options data that we're looking at. The sector I'll be looking at today is tech. As of now, it doesn't come under any of these tariffs. It's been a relative underperformer. There'll be some depreciation that we're seeing on the Indian rupee as well. So interesting to see whether tech could be the place to hide just in the near term. Macro struggles continue, but otherwise, let's see whether or not tech can outperform. And the Nifty Bank, if the Nifty needs to fight back, then both these two levels are important. The 20 and the 50 DMA become the resistance zones that we're looking at. So disappointing stuff coming in overnight, but it appears the street sniffed it in the last month or so.
Can the bulls somehow work a miracle? Can they prevail by the end of the day? We'll see. But we have a very packed lineup and we'll be going down full throttle, giving you a 360-degree perspective on what this latest tariff announcement could mean for India. We start off with Nilesh Shah of Kotak Mahindra AMC, Nilkant Mishra of Axis Bank, Anand Shah of ICICI Pru AMCs, all of them joining in to discuss how the market could be reacting and interpreting what has been announced by the US President yesterday. We'll get you reactions from India Inc. Pearl Global Industries joins in. They're, of course, pretty big in textile exports. So what could the impact be for textile and apparel segment? We'll talk about that. Then we bring you reactions from some of the top diplomats in the trade sector, like former Finance Secretary S.C. Garg, Ajay Shah of FIO, Anjali Prasad, former envoy to the WTO, former Foreign Secretary Kavan Sibbal as well. We also have Dr. Amitendu Palit of ISAS, Jayant Das Gupta, former envoy to the WTO again. Former Commerce Secretary Anup Vadhavan will also join in. Ajay Srivastava of Global Trade Research Initiative and Raymond Vickery of CSIS. So that's plenty of very deep opinion coming your way. And in just a moment, we'll be in conversation with Ed Yardeni, get your global perspective as well on how India will deal with 25%, whereas a lot of other countries have gotten 15%. And of course, Sameer Narang of ICICI Bank also weighs in. So packed lineup coming up.
Okay, well, absolutely packed, right? And Ed Yardeni is with us. He's president at Yardeni Research. Sameer Narang is head of economics research group at ICICI Bank. So two excellent voices right at the top of the show. Ed, that graphic will come up on your screen, and that's the point. 25% plus penalty for India, 15 to 20% for most others. And that's to my mind the disappointment in that sense, and maybe this will be negotiated lower, hopefully. But what's your sense?
My sense is that this is Trump's art of the deal. He's frustrated with the way the negotiations have been going, and he's just trying to put more pressure on India to give in on some of the points that he's been pushing for. And so I think it's still an ongoing negotiation. This is the way that the president negotiates. And even if you get to August 1st, even if you get to Friday and it's still 25%, that doesn't mean it can't change. I mean, nothing is fixed in Trump world. Everything can change. Everything can be renegotiated. None of these things are treaties, you know. They're all just kind of very loose agreements that could always be amended the following day.
That's true. Nothing is cast in stone. That's a positive way of looking at Mr. Yardeni. The thing is that we're at 25%, whereas a lot of other countries in the last 2 weeks have gotten a 15% deal. Would that perhaps make foreign investors look at India, a little more negatively? Or will it be taken in the stride? Because, I mean, the GDP impact, and, we've been doing the numbers here, asking economists as well. The GDP impact, most people say, is ranging between 0.3% to maybe 0.6%. So 0.5%, give or take. So it's not huge in that sense.
Well, I think ever since April 9th of this year, when Trump postponed his reciprocal tariffs, investors have come to conclude that, as I said, this is an ongoing process of negotiating trade deals. There's no fixed final conclusion here. And so, no, I don't think that investors are suddenly going to turn off to India because the president today said 25% plus a penalty. Again, that could very well still be intact on August 1st, but depending on how negotiations go, that could be amended pretty quickly. It could still be 15%. I think the problem that India has compared to other countries is as the president's advisors, the president views that India is being much tougher about letting American products into India, while India enjoys a pretty wide open market in the United States. And then the other point of contention is the concern that India continues to buy oil from Russia and military equipment. And so these are all items in the ongoing negotiations. These negotiations aren't done behind closed doors. They're very much done in public. And it's not much fun, and it can be very unsettling to watch these negotiations going on. But as we've seen in other countries, they do at some point settle down. Investors have already kind of figured out how the game is played. And so I don't think this really has any major repercussions for India as far as I can see.
All right, Ed, stay with us. Let's get Samir as well into the conversation. Hi, Samir. Thanks a lot for joining in. Well, so if you could tell us, what kind of impact will this tariff have on the Indian GDP? According to your estimates, what could the hit be?
Well, our exports to the US are around, 88 billion last year, though they've been growing over the last few years. That's around 2.1, 2.2% of GDP. Now, exports to the US are growing quite good. So if that growth moderates from, say, 22% to this flattish, then to that extent, that will have an impact of 20, 30 basis points. Could be even lower because exports to other geographies have not been picking up. And as we can see that once the trade tensions are sorted or they come down, exports to other geographies may pick up or rerouting may happen. And in particular, our exports to the US are driven by mobile phones, textiles, pharmaceuticals. Some of them perhaps may not be also getting substituted by other countries like pharmaceuticals, where we have a large share in generics. And, some of them are also were excluded till such point in time. So my sense is the impact will not be that high, it will be marginal. And any which ways, some of it was expected because a lot of front loading into the US exports have happened. And we are more or less a domestic driven economy. So I think the impact on the economic front would be marginal, but it would be there if the tariffs sustain at 25%.
Got that, Samir. But, there was hope that, various sectors like the electronics, textiles, they could be favorably placed. Now, those sectors get hit. Could you tell us what is your read-through of that? Pharma, as we know, continues to remain exempt for now.
No, so you're right. Actually, if you look at India's export basket, it's largely driven by petroleum products, energy, then you have textiles, you have chemicals, excluding pharmaceuticals and other organic chemicals, gems and jewelry, as you pointed out, and, engineering goods. But when you look at our export basket to the US, it's largely driven by electronics or mobile phones. It's driven by textiles, driven by gems and jewelry. And it's driven by pharmaceuticals. So energy exports and other engineering goods, including transport equipment, is not what we export to the US because US itself is an energy exporter, and it's a lot of activity happens on the auto front any which ways. And we are linked to the auto supply chain, but not as a final, car producer, but through other, ancillary auto activity. So the hit would be largely, if tariffs remain at these levels, would be on textiles, would be on electronic goods, including mobile instruments, gems and jewelry, any which ways have been degrowing this year to the US. Though exports to the US are growing in excess of 20%, gems and jewelry have been moderating because of, lab-grown diamonds, as well as the fact that discretionary demand in the US has been relatively weak. So some of these sectors is where you will see maximum impact. However, we should keep in mind that if tariffs on Vietnam and other Asian manufacturing countries are at very similar levels, so there will be an absolute contraction in demand perhaps going forward, and that will impact all Asian economies at the same level as it would impact India.
Okay, got that point. Just stay on, Samir. Mr. Yardeni, if you could just hear the other panelist, Samir Narang, that's exactly what he was saying, right? So if you calculate, the impact is, 30 basis points, 40, 50 basis points. But to your point that you made, that now this whole tariff negotiation is a bargaining tool for a much wider, geopolitical relationship that we have. This is about perhaps buying Russian oil, buying Russian defense equipment. So to that extent, could it cast another shadow in investors' mind on India? I mean, would they look at the US-India equation itself? Would that be a new impediment, or you think that'll not really be a big issue in foreign investors' mind?
I think President Trump several times in discussing the importance of India's relationship with the United States has indicated that he'd like that relationship to be even closer, and he'd like to see India not really side with Russia or Brazil or China on issues like the dollar in the international system and and simply be kind of closer geopolitically to the United States. Well, that's what Trump would like, but obviously India has its own national interests, and it's geographically much closer to China and Russia and Iran. And so naturally, India is going to want to try to have good relationships with people that are in its neighborhood. But that's going to create some frictions. But I think, again, at the end of the day, Trump, well, wants deals. He doesn't want to see these things kind of fall apart. And so I think he's just going to push until he gets the most he can out of India. And I think India will give him some more. But I guess there are domestic limits in terms of how much these markets will open in India. But some of them will open.
Okay. No, I think that's a point taken, and I think you began by saying, right, that this is out of the deal as far as Trump is concerned. Samir, just last question, and something that I asked Ed right in the top, which I want you to respond to as well. You know, we are at 25 plus penalty. Most others are 15 to 20%. When we started this in March, April, it looked like we perhaps will have an advantage. You know, it's not an advantage, it actually is a disadvantage, because just purely sheer absolute tariff rates. That's something that sort of bothered me. I don't know what you make of it, Samir. Go on.
Very good question. When we started this discussion, our hope was that relatively we'll be better placed because we also have a much lower trade surplus with the US compared to some of the Asian peers. I think we are still in a negotiation phase, Prashant. We should not forget that. Ultimately, the tariffs which may come into play would be a bit different from what we are seeing today. But the baseline tariffs have increased from 3%, as I was speaking earlier. For most of the countries like Japan and the European Union, it's around 15%. For Asian manufacturing, it's around 25%. With China, it's slightly higher. Now, if we are able to do a good deal, perhaps we'll see tariffs slightly lower than the other Asian peers. But I think where it hurts most is the fact that it impacts incremental investment decisions to be taken by corporates, where to invest capacity in terms of supply chain creation in the world. As we have seen that over the last 3-4 years, we have seen incremental capacity creation in India in terms of electronics. And setting up an incremental capacity takes at least 3-4 years, if not longer, in any geography, given these spate of approvals that are required. So to that extent, yes, it is marginally negative in terms of tariffs where they are, and it may have an impact on investment decision making. But I think these are still, negotiations that are going on, and we may see eventually tariffs being a little bit different from what they are today. And we should not forget that services exports is what is the key, element for India's exports as well as goods. And there, as of now, though IT services firms have been reporting muted earnings, but Q1, we have seen net services exports stabilizing around $15.7 billion, which is around $2.5 billion higher than the same period last year. So despite goods exports being relatively flat at around 2% higher compared to last year's same period, services exports are still doing fairly well. So you have, this duality between goods and services exports in India, and that perhaps will continue for some more time, but it inevitably raises the uncertainty. Yes.
Appreciated Samir as well as Ed for joining in and giving us your take on this overnight development with regard to the United States imposing 25% tariff on India. We look forward to chatting up with you all in the coming days as things will remain very, very volatile. By the time we slip into a short break, on the other side, we focus on all the stock-specific action in our special Top 10 segment, looking at Tata Motors, Tata Steel, Jio Financial Services, Mahindra & Mahindra, Navin Fluorine, and Keynes Tech. All of them will be reacting to positive news flow, while you have IndiGlobe Aviation, IGL, Hitachi, and Indus Stars that will be reacting to negative news flow. Take that break, come back, get into further detail on all these names.
Welcome back. So we're bracing for that gap down. The implied open is telling us that the start will be 200 points lower. There are, of course, a lot of individual stocks that we need to take stock of as well. So let's straight away get to our team. 185 points now in the implied open. Let's straight away get to our team. Guys, morning to all of you. Tata Motors, the news is official. They're indeed looking at that Italian acquisition. Sudarshan, morning.
Good morning, Surbhi. So I would say it's not a bad deal for Tata Motors because it's going to help company diversify and increase its exposure in the global market. So the deal has been announced. Tata Motors is going to acquire Italian company that is Iveco Group, and this deal is only for the auto part, not the defense part. Iveco Group is going to delist and demerge the defense part, and after that, auto part will be sold to Tata Motors, and this deal is for 3.8 billion euros. In rupee terms, it comes around rupees 38,000 crore. So if you just try to know about Iveco Group, so currently in the Europe, it has a market share of 12 to 13% in LCV segment, 8 to 9% in M&HCV segment, and 50.5% in intercity bus market. That's in Europe. Also, it has an exposure in South American market where it has doubled its bus market share from 4% in 2023 to 8% in 2024. Why it would be positive for Tata Motors? Remember, Tata Motors has already announced that it's going to demerge, and basically PV would be a separate business and CV would be a separate business, and that is going to happen by the end of this fiscal. And JP Morgan believes that once the demerger process is done, mostly CV business would be net cash. So on the debt part also, this 38,000 crore would not be a big deal. So overall, I think it's positive for Tata Motors.
Okay, all right. Thanks a lot for that, Sudarshan. Positive for Tata Motors is what Sud's call is. Going across to Gaurav, he's here to tell us about Jio Financial. Morning, Gaurav.
Well, good morning. Now, promoter group Reliance Industries is going to increase its stake in Jio Financials almost by 4%. So let's understand how. Yesterday, board of Jio Financial, they have approved issuance of warrants. 50 crore warrants will be issued at a price of around 316.5 rupees, which is just about 1% discount to its last trading price. And this will be used to raise around 15,825 crores. Now, these warrants will be issued for two companies, Sikka Ports and Terminals, where the stake will be increased to 4.65%, and Jamnagar Utilities and Power, where the stake will be increased to 5.52%. Now, both these companies belong to promoter group Reliance Industries, and with this, on an adjusted basis, Reliance Industries will increase its stake almost to 51%. Now, remember, these will be warrants which will be convertible into paid-up equity share on or before the time of expiry of 18 months. So definitely it shows that Reliance Industries, the promoter group, definitely has some positive plans for Jio Financials as they are increasing their stake.
For that, Gaurav, well, I'm looking at Tata Steel, and global uncertainty continues, but these numbers look good. It's an improved performance that they come out there, and the EBITDA, consolidated EBITDA number is better than what our polls drop. How is that possible? The European business turned EBITDA positive after 10 straight quarters of losses, and the India business as well. There was relative outperformance that we saw out there. So let's get straight to both those two verticals. As you can see, the India EBITDA per ton did beat estimates. And that, keep in mind, is despite the fact that they had a shutdown in the past quarter. So that was encouraging. And Europe turns into the green, $8 per ton, little better than what most on the street were anticipating. And that's because the Netherlands business, well, the profitability went up to around 600 crores for the quarter, which means that they did close on $48 per ton of an EBITDA per ton. And the losses in the UK business came down by half. That's encouraging. How is this possible? Well, they had a cost transformation that they had outlined for the year. They had laid out close to 11,500 crores. Ballpark around 2,500 crores have been achieved in the first quarter itself, which is good. So these numbers look good on the whole. So going with the tinge of green out there, though the market is going to be a little bit jittery. Only problem is the debt continues to remain elevated. Capex of around 3,500 crores. That's what added on to the debt. But these numbers go down as a beat. Going back to Sudarshan, Mahindra & Mahindra, how are the numbers, sir?
So for Mahindra & Mahindra, earnings for Q1 of FY26 were largely in line with estimates. What has worked for the companies? First, on the volume front, both SUV and tractor segment continue to see volume growth. Volumes were up on a sequential basis. And even in the market share, for SUV, market share has crossed 27.3%. It's the revenue market share. And the tractor segment market share has increased to more than 45%. That's the highest ever. And company, even going forward, the launch pipeline that company has laid out is looking very strong. What are the negatives? First, raw material cost, that continue to see an increase, and that is impacting margin. Another thing that's going to impact margin is that going forward, low variant EV that company will start selling, that might drag margin. Now talking about the headline numbers, profit was up 32%, revenue has increased 26%, EBITDA 2 was higher 18%, and margin has come in at 14% versus 14.9%. Brokerages, Jefferies maintains by target here is 4,000 per share. MS also maintains overhead call and target is 3,668 per share. So overall, it's positive for M&M.
All right, so thanks very much for that. Management coming up at 10 a.m. And you'll hear from Manisha himself a little later. Interglobe is the next one. Winnie's got details here. A bit of disappointment, Winnie. Morning.
Good morning. Yes, a bit of a disappointment that came in from Interglobe Aviation, but this is what was expected in Q1 FY26. Why? Three impacts coming in here in Q1. One was the impact of the India-Pakistan border issue, the plane crash in Ahmedabad, as well as the Middle East. Geopolitical tensions actually caused a bit of an issue in terms of air traffic and rerouting. These were the three impacts coming in for the company in Q1. But despite that, they've managed to see around a 5% growth in terms of revenues. EBITDA margin, that is down around 150 basis points. When you're looking at it on a year-on-year basis, 28% is what the EBITDA margin came in at. Profits impacted because of the lower compensation that has come in from Pratt & Whitney, so impact on the profitability as well. When you're looking at the passenger load factor, that's come in at just 84.6%, which is much lower than what we were expecting, 86%. Yields also are seeing an impact coming in. So weaker yields, the demand issues coming in, impacting the overall company's performance. But management has given positive commentary coming in, especially in July as well. They're saying that there's stability in terms of demand from July, and Q3 and Q4 onwards, they're expecting better recovery coming in here.
Okay, all right. Thanks a lot for that, Vinny. Let's go to Vamakshi. Vamakshi, Hitachi Energy, the stock has seen a big run, and these numbers are a little bit disappointing. But, you know, if you look at it, Q1 normally is a soft quarter in terms of margins. But tell us more.
Well, Nigel, bang on. It's a weak set coming in from Hitachi this time around. Perhaps the street was expecting execution to pick up a little more than what the company has reported. The revenue is seeing an uptick of almost 11% on a year-on-year basis. The gross margins have improved by around 721 basis points, which means well for the company. It's at almost 44.4%. But this is not actually translating into the EBITDA margins because they're at 10.5%. Nevertheless, this is still an improvement of almost 687 basis points. And the net profit is seeing a very sharp jump from around 11 crores to 132 crores this time around. And this is because Q1 last year was extremely weak for the company. But when we look at these numbers, as far as street expectations are concerned, it's a miss. Apart from that, the ordering activity though came in higher than what the street was anticipating. Order inflow stood at 11,339 crores, largely led by the Badla-Fatehpur HVDC win and the bulk order that they got from Power Grid. The analysts roughly believe that the HVDC order out of this order inflow stood at somewhere around 7,000 to 8,000 crores, and the order backlog stood at 29,100 odd crores, which is the highest ever for the company. So good order inflow, but overall the numbers have missed street expectations, so therefore going with a red for this counter.
Okay, all right, got that. Thanks very much, Vamakshi. So Hitachi disappointing in the first quarter. Let's move on then and look at Indus Towers. Rima, morning. Any good news here?
Not really. Slightly disappointing. Margins for Indus Towers have missed estimates. They've declined by 240 basis points on a quarter-on-quarter basis. That's put pressure on the company's profitability. So profits are down 2.4%. Plus, there is lower other income and higher depreciation and amortization. The tower additions too have moderated. This is because Bharti has largely completed its rollout. So tower additions have moderated, and plus the company hasn't announced any dividend or a buyback. So that might disappoint some shareholders.
Rima, thank you very much. Naveen, Fluorine and IGL are next. Sonal?
Yes, Naveen Fluorine, strong set of numbers. It was a strong growth that we saw. Revenues are up 39%, EBITDA is up 106%, margins expanded by around 900 basis points, leading to a profit growth of 128%. All three segments did well. The management commentary is very positive. HPP up 45%, specialty chemicals up 35%. CDMO also did very well this time around. Citi has in fact gone ahead and increased target price on the stock to 47.50. For IGL, it was largely in set of numbers, but EBITDA was slightly lower because of higher gas costs. So revenues flat, EBITDA up 3.6%, margins expanded by 500 basis points, profits were up just 2%. Volumes were up on a YOY basis, but they declined on a sequential basis. CNG sales, industrial volumes, PNG volumes, all of them up on a YOY basis, but the growth has been lower than MGL. But we'll watch out for management commentary in the conference call today.
Okay, all right, got it. Sonal, thank you very much for that. That's IGL. Upasana's with us for Keynes Technologies. Upasana, remember, Amber did really well. Keynes from a related space. How have they fared?
Well, Surabhi, Keynes has reported a mixed set of numbers as compared to our poll. Now, revenue was a miss, while PAT is largely in line, but it's a margin beat this time around. Now, coming to the revenue first, it stood at 673 crore with an uptick of 34%. Now, the reason why I say it's a miss, because company has guided for a 60% growth for FY26. So if we see on a relative basis, 34% growth in Q1 is a might miss on that front versus the poll number of 759 crores. EBITDA saw an uptick of 69% on a year-on-year basis. EBITDA margin stood at 16.8% with an uptick of 350 basis points with the poll much above our poll of 14.6%. Now, this company has surpassed FY26 full year guidance of 50 basis point margin expansion. Now, coming to the order book of the company, that has also seen a strong growth of 37% on a year-on-year basis, giving a strong revenue visibility. PAT largely in line with an uptick of 47%, stood at 75 crores. And also, if we look at the other expenses, that have also hiked up almost by 1.8 times on year-on-year basis. So all in all, mixed set of numbers coming in from Keynes Technology.
Okay, all right. Thank you very much, Upasana, for that. We take a break. We're back. Prakash Devan joins us for some fundamental stock conversation. Lots to get through over the next, 30 minutes or so to market open at 9:15. Coming up.
Welcome back. Well, as promised, Prakash Devan joins us to help us out with some fundamental analysis. Hi, Prakash. Good morning. Good to see you win. Well, one stock that could relatively outperform is Jio Financial because the promoter entity is showing the faith. What's your view on the stock at around 310, 320 levels?
Good morning, Nigel. So I think this just reaffirms the management's intent to kind of build this up into a financial powerhouse. We've already started seeing a slew of announcements, a lot of launches that are underway, but there's much more to come. And, you know, at some point in time, the company would need capital infusion. They've already spoken about a fundraise, but it makes sense if the parent could kind of support it at that point in time and consolidate its ownership and shareholding. From a stock perspective, it's still some time away before it crosses its all-time high. But then that all-time high was probably made at a time when things were not very clear. With this clarity, I think it will have a decisive move in the next 12, 18 months. And I would believe it definitely gets you a significant upside. And the benefit is now that Reliance Industry also has some rub-off from that 51% ownership that resides in that.
Okay, all right, got that. Prakash, hi, morning. Tata Motors, it's finally official. You know, we were just discussing it the other day, but now it's official. They're doing this Italian acquisition, 38,000 crores. Would you view it as a positive because new markets, aggression, or could it be an overhang because of the size and maybe the debt involved?
So, good morning, Subhi. So, we'll, of course, as I said, you know, it was too early to call it a bad investment at that point in time when details were not clear. But things are kind of emerging where it could kind of start sitting in as a piece on the Tata Motors balance sheet with a carve out of the CV domestic business also kind of getting there. And there's a very clear focus. Remember, one of the biggest market shares this company, the Italian business, has is for buses. And in India, with the rapid development of infrastructure within cities, these corridors coming up, I think there's going to be a huge influx of that means of transport, which is not yet part of that. I mean, you go to Europe, you see these Flix buses all the time, and you start using these. You have the Greyhound in the US. That's the kind of infrastructure which could develop, but it's some time away. What you do on a stock like this, at this point in time, you of course wait for more details and see how the digestion happens, how this absorption happens on the acquisition. And that normally gives you enough time. So I wouldn't be in a hurry to buy, but it could be much more positive than what it seemed when the deal was announced, given the acquisition cost and the leverage. But they'll probably have a solution to that as well, I'm sure, as details unfold.
Okay. Yeah, absolutely. And we have to see, when you very rightly brought that up, that this purchased entity, eventually it will sit in the CV entity's balance sheet because there's a demerger that's underway anyway.
Absolutely. Prakash, what about Tisco? Tata Steel, actually the numbers look good. When you have no operating leverage that plays out, and yet you report a good improvement in the EBITDA per ton in India. Netherlands is doing even better and Europe is cutting its losses. So that's good news. But what's your view on the stock from here on?
No, absolutely. Had it not been for the uncertain times, Tisco would have done its Tisco, as you keep calling. And importantly, what's happening is these changes are not one-off, Nigel. If you read through the commentary, the kind of details on the numbers, it's a cost control exercise that they'd initiated for the UK business, and that's how the losses. I mean, and I think in the next 2 quarters, they could probably have no losses at all. So when operating losses go away, that's the final stage before which you would start kind of kicking operating leverage. And from a scale perspective, while they've not expanded too much organically in the last few years, I think they'll probably consolidate all their operations, get more profitable, maintain margins for at least 3-4 quarters, and then things could look very different as demand clarity emerges. So the domestic demand itself is quite robust now. We've seen how other players have been benefiting from the scale-up that they've done, whether it's JSPL, JSW, even SAIL in some certain pockets. So I'm quite positive. But steel as a sector is not yet at the right stage in the cycle. That's the only issue. On a bottom-up basis, Tata Steel looks very promising, but we'll have to wait.
Prakash, 30-second, on the treadmill running today and unsuccessfully maybe. But Aurobindo, big acquisition. Any thoughts?
No, I'm very wary of these acquisitions, especially by companies which haven't done great in the past on some of them. So this is much more to choose out of.
All right, okay. Aurobindo's perhaps already got the largest manufacturing amongst Indian pharma companies, US manufacturing capacity, and this is another one. More on this later. Prakash, thank you very much for joining us. Good speaking with you here on CNBC. We'll take a quick break here. We will come back with the management of Pearl Global and tariff impact with Pearl on the other side. Stay tuned.
Okay, we are getting the pre-open rates, just putting them up for your reference, and they should settle. I mean, they should definitely settle because the implied open was about 200 points lower. This is just for a sentiment reaction coming in on the Nifty. So let's just wait for this to calm down a little bit. Let's get to our technical experts as we're looking at some of these rates kicking in. Sudarshan and Mitesh are both with us. Gentlemen, good morning. We're preparing for, a gap down, and maybe they say the market always knows best, right? Maybe this was always building, this weakness that we've had over the last 1 month. Now tell us what should be done. I mean, index, do you look at buying at any point or just stay away completely? Sudarshan?
Yeah, good morning. Well, as you said, it's been building up, and both of us have been saying for the last 10, 12 days that we are looking at weakness. I have given a support level. Remember, it's not a target, a support, technical support of about 24,500, and then we take it from there. So the chances are we'll reach that level sooner or later. There is no trade in the Nifty. It's just a repetition of what I'm saying every day. You don't go short because you don't know when the markets will have a V-shaped rally. Even intraday would kill you. And you can't go long. This is not a buy on dips. The markets can go much lower.
Okay, that's important caution that Sudarshan's placing on the table. Mitesh, come in on this. Would you agree or would you say that some of the more adventurous braveheart traders can perhaps buy at some point today? Let's talk Nifty first.
Good morning, Surbi. There is no point buying when you're not sure that we'll get an upside. My idea has been that, we will do a range and possibly sometime in the next 2 days, and that's what I've been highlighting, that we'll head towards 24, 550, 500 zones, which is the first support area. I think with this gap down, we might actually be on course to do that. Now, from those levels, if we see a reversal pattern, then is the time, when you want to pull a trigger on the upside. But otherwise, wait and watch. On the stock side, though, we've been trading with mixed bias, both long and short side. But on the index, around 24, 550, 500, if you get a reversal sign on the hourly or the 2-hourly charts, I think that is when I would want to venture into a long trade.
Okay, all right, got it. Both of you all sounding a little bit cautious on the headline index. And for starters, we like to start off 200 points lower. But let's talk about stocks. Mitesh, you go first. What's in your radar?
Morning, Nigel. I have more of sell calls today. A sell on Canara Bank with a stop at 110.5 for targets of 104. A sell on Indian Bank, so 2 banking names over here. A sell here with a stop at 626 for a target of around 580. And a sell on a short trading. It's a conditional sell. There's some support at 121, small minor pivot. So if it starts trading below 120.5, and that would happen in the opening itself, then go short with a stop at 122.5 for a target of 116, and supplies a buy on mild declines around 1545, 1550. Buy with the stop below 1525 for targets of 1520.
Okay, all right, got that. Sudarshan, what about you?
Well, it's a mix. NTPC is a buy with a stop under 332. ICICI General Insurance, ICICI GI is a buy with a stop under 1884. I have 2 intraday shorts, both of the same sector approximately. PPL Pharma is an intraday short and same group also with a stop above 205. And PEL, Piramal Enterprises, is an intraday short with a stop above 1313. And there's a warning. Today is weekly expiry and monthly expiry. Please do not dabble in expiry options.
All right, gentlemen, we speak again in a bit. Thank you very much, though, for that setup and those specific trades as well. Nilesh Shah is now joining us, Managing Director at Kotak Mahindra Asset Management Company. Nilesh bhai, good morning. I'm wearing green, you're wearing red. I just noticed. But I'm sure not. That is the Kotak color, though. It's not an indication for anyone who's confused or wondering. But I just wanted to start with what I put out this morning, and the table will come up for our viewers once again, right? When all this started, Nilesh bhai, in March, April, the hope implicitly here was that we'll correct some of the tariffs lower for us to be able to sell to the US versus competing countries. As things stand right now, and hopefully this gets negotiated lower, we are 25 plus. Most other countries are 15 to 20. So that's the beyond markets here and now. Is this the bigger disappointment? How are you reading this?
Undoubtedly, Prashant, but this is a disappointment. In the April Liberation Day tariff, India was on the lower side and countries were on the higher side. Now, as things stand today, even without penalties for Russian trade, we are on the higher side. And countries like Vietnam, which is transit for China to some extent, are on the lower side. So undoubtedly, from being placed in the front category in terms of favor, we have now moved towards the back category. Well, the positive side is that even a one-trick country like Bangladesh, which is dependent upon textiles, they were levied heavy tariff on textiles much higher than India. And by and large, they have survived. So clearly, we have to focus on our domestic economy and continue to engage with US to get some offset and to get some exemption for items like pharma, hopefully that will ensure that the overall tariff which will be levied on India will still be manageable.
Nilesh, good morning. So good to have you on. You know, and it's become a bit of a perfect storm because now we have this tariff issue, which is a sentiment negative. We anyway had FPI selling. And then we have the earnings story, which we all been waiting for that turnaround. Now, in this perfect storm, the only light on the ship seems to be the light from domestic investors. Those flows that have been consistent, those SIP numbers that have been consistent. But aren't the headwinds becoming a bit much? Because investors' patience is also getting tested. It's been a ranging market for a while. I mean, what do you see ahead next couple of months?
So, Surbhi, for 10 years, we delivered positive return. At some point of time, law of average will catch up with us. And as you very correctly mentioned, we are in a perfect storm right now. Valuations are on the higher side. Earnings growth is in mid-single digit to high single digit this quarter. And on top of it, from being somewhere favorably placed on tariff, we are now probably placed on the slightly unfavorable side. Domestic investors will have to be long-term investors and they'll have to moderate return expectation. We still believe our long-term growth story remains intact. In US policy making, we have seen many flips and flops. As we speak today, copper prices in US are on the way down because refined copper has been exempted from the tariff unexpectedly. So there will be always U-turn in US policy making as longer-term strategic interests of India and US are aligned. I just hope and pray that we focus on accelerating domestic growth and then we get support from domestic growth as well as exports over a period of time.
Indeed. All right. So the domestic piece becomes far more important and some kind of monetary support as well as something that we'll be looking forward to. Nilesh, just please stay with us. For the time being, we're just going to hop across and discuss the impact of India Inc. We have the management of Pearl Global who's waiting by. But first, let's go to Hormuz. He's here to give us a roundup of which sectors will be impacted by Trump's tariffs. Hormuz, take it away.
Good morning, Nigel. And a lot of sectors are in the spotlight because of these developments. You take a look at auto component manufacturers, take a look at shrimp feed exporters, the industrials and consumer electricals, gems and jewelry, textiles, and including the mobiles and electronic stocks as well. All of them likely to face an impact. We start off with the auto component names where Nuvama is mentioning the fact that the CV and other component tariffs currently was at 10%. Now that will increase to 25%, and that could have negative impacts on names like Bharat Forge, Ramkrishna Forgings and even Balkrishna Industries, which has a significant export share as a part of its top line as well. And this negative impact can be felt due to a reduction in underlying demand as well as absorption of the tariff cost. So this is what Nuvama has had to say. Now, textile companies too have been in the spotlight because of this tariff announcement. And most of these textile companies, Gokul Das or Wellspun Living, Indocount Industries, Pearl Global, all of them have an exposure of anywhere between 50 to 70% from the US markets. Now, when it comes to industrial stocks, Elara has come out with a note and they mentioned that while the cables and wires segment have no significant exposure, most of these players have a 2 to 5% kind of exposure to the US market. For conductors, they've specifically highlighted Apar Industries, where it says it has a 15 to 20% exposure to the US, and KC International's exports come via one of its units to the US, and that's the smaller number of 5%. When it comes to capital goods, they mentioned that Cummins India has a 12 to 15% exposure to the US, and most of it goes to its parent company, that is Cummins Inc. And MTAR Tech, the clean energy business of the company, is almost 62% of the overall top line, and most of that comes from the major client being from the export market. And you have stocks like Azad Engineering, Keynes Tech, Dixon, and they say that these Dixon Tech and other stocks have no significant exposure. And the gems and jewelry, the GJEPC put out a statement yesterday that this is a significantly negative development. So lots of sectors to watch out for, you see, as the day unfolds.
Thanks a lot for that, Hormuz. Well, let's get in one market participant. We have Pallab Banerjee, the Managing Director and Group President at Pearl Global, who joins us. Hi, Mr. Banerjee. Good morning. Thanks a lot for joining in. 25% has come as a bit of a shocker. For your business, what was the current tariff, pre this 25%, and how does it compare with what's been announced? And do you think it will put companies like you at a disadvantage on the global front, because we were hoping that we get a lower tariff and then India goes ahead and grabs a greater share? Please go ahead.
Good morning, Nigel. Definitely, it's a little bit of disappointment as of what we are hearing from President Trump. But I'm sure like this is a part of his negotiation tactics. India has to negotiate, and yes, I think the style of negotiation is very different in this case. And even the country's leaders like of Japan and EU has declared it as a tough negotiation.
Pallab,
process.
Pallab, we'll keep the negotiation at the side. What is the current rate you're paying, and how does 25% compare with it?
So, for example, like anything which is going out from any of the other countries till April 2nd, it was only subject to the MFN or the WTO tariff, which was for cotton product anywhere between 12% to 19%. And for synthetics, it was about 26%. Certain other products like natural fibers like linen and all was little lesser. So every product had a different kind of line item in terms of tariffs. Now on April 2nd, after the first announcement, we had a 10% baseline that was added on to this. And now it seems to be that this 10% will be replaced by this 25% and the so-called penalty, which we don't know as of now what's going to happen for India. But for other countries like Indonesia, Vietnam, has been already declared as 19 and 20%. Bangladesh will come out, I think, in the next days. I think they're also in discussion. So these are the countries that where we are exporting from Asia. And we also do from Guatemala, which is at flat 10%.
So, Pallab, that's precisely the question. I mean, you have the benefit of having a lot of manufacturing bases in geographies which now have better tariffs than India does. For instance, Vietnam, you mentioned Bangladesh as well. So for you, what is the increase? The blended tariff rate for you goes up from what to what for Pearl specifically?
So one thing is that we are not paying the tariff. The customer who are taking the goods from us are paying the tariff. Yes. But yes, it's a disadvantage. So if you see like for all these countries, as of now, this is stacked upon the WTO tariff. Now, there is a confusion. If you go back to what President Trump had said before coming into power, or when you look at the economist Stephen Miran's document, they were trying to replace the WTO tariff by this reciprocal tariff. Now, that is at this point of time silent. Most probably it will happen at some point of time.
So net, sorry, Pallab, just running into market opening, net, because you're producing from other countries like Vietnam, will it offset the India impact? Are you not impacted?
So no, for us, the impact is very minimal. If I look at our top line, 15% of our exposure is from India to US. So that definitely our customers will push us to move to other countries. And I think India, we are very well entrenched as other free trade countries like, Japan and Australia and all. So I don't see a big impact at this point of time.
Pallab, but for the industry, you would say this puts the industry at a bit of a disadvantage?
Oh yeah, big time.
Big time.
And see, what's happening is that India is very strong in this particular season, which is the spring-summer season of the Western countries in the Northern Hemisphere. And this is the time these orders are getting booked. So this timing is very bad. In fact, a lot of customers who were placing the business in the last week of July, they pushed it out to the first week of August because they wanted to hear this. The timing has been not in favor to the Indian industry at all.
All right, Pallab, we'll leave it there. Thank you very much. Sorry to rush you. Maybe we can have a longer chat later. Appreciate it very much. Nilesh Bhai is still with us, and we'll just sort of bring him in, just taking note of the opening rates as they come in, and then we'll continue our conversation with him. 24, what do we have? The first rates as they start to appear up, 170 points lower on the Nifty. 24,676 is where the index is at. It's about 0.5%, 0.6%, 0.7% lower. So all said and done, right? And look at the Nifty Bank, which is down 0.4%. So 55,930. And the mid-cap index is down 1, small-cap index is down 1. So unless things worsen significantly from here, 0.5% cut, not bad at all, given a lot of the hullabaloo that we have been sort of seeing. Of course, the news hit as a bit of a shocker, and I explained why the disappointment, particularly vis-a-vis other countries. You heard Pearl Global as well talking about one of the most sort of much anticipated sectors, which was to benefit, which is textile, which has not happened. But this is not bad. 0.6% lower. There's one name in the green, Geo Financial. 49 stocks in the red. That's the heat map. Surabhi.
This could have been any morning, Prashant. I mean, just about 0.6, 0.7% down. This could have been any morning. So, you'd say it's a fairly resilient start by the market. And let's see, and we'll ask Nilesh in just a bit, domestic institutions, whether they'll use this opportunity, whether there'll be big buyers today or not. What's his sense? We'll get to Nilesh in just a second. But stocks right now, Tata Motors is still negative, reacting to their decision to buy that stake in the Italian CV maker. 2.5% lower on that stock. BEL is on the lower side. Reliance is a drag this morning, 1.5% down, not offering too much support. Mahindra & Mahindra, pretty decent performance, but it's that kind of a day, taking some profits off the table. 1% down on M&M as well. So overall, stocks are down between 1 to 1.5%. Tata Motors is the one that's down nearly 2%. On the upside, Jio Financial up about 0.7%. There's some buying on an SBI Life. The stocks that are closest to the flat line are coming in from the FMCG space. So let's see if they break into positive. Nestle, Lever, ITC, Asian Paints. There the cuts are the least. And Infosys, remember yesterday Mr. Salil Parekh sounded not as bearish as TCS. There was no talk of job cuts at Infosys. In fact, he was saying that Infosys is hiring 20,000 freshers this year. Stock is down 0.5%. I'll watch for FMCG and IT very, very carefully to see if some buying emerges with these stocks. But right now, still down 200, Nigel.
Well, Welspun Living, that's taking it on the chin, down 6% as we speak. So that would have been a potential beneficiary if in case the tariffs are lower. Now the street doesn't like what they've seen, 6% lower. Trident is down another 3.5%. So big hit on that one. New India Assurance is giving up some part of the gains that it put on yesterday. And Indus Stars, well, those numbers were disappointing and the dividend pushback as well. So the street is punishing that name. What's doing well? Sagility, that's up close to around 5%. Those numbers look pretty good. You have Jio Financial that's doing a relative outperformance. The reason being the promoter entity is showing the faith and, putting in money. And Greaves Cotton is actually one of those stocks that are actually outperforming today on rather large volumes. A big up move is what we are seeing. And HEG as well. They've been talking about realizations improving. Now they're going ahead and, in fact, announcing a capex as well. So they're readying themselves for the next 2 to around 3 years when they expect demand to come back. The street likes it, explains why. That name is up close to around 5.5% as we see.
It's 300 up and about 2,000 lower. That's the sort of count of advanced decline out of the gates, right? I mean, just the first initial couple of minutes of trade, but that is what it is. Sagility is another one which reported a super strong set of numbers, and that is reacting at about 4% or so. It's not done very much since listing. That is Sagility out there. Look at the volumes as well. I think Nigel mentioned HEG, Greaves, etc. 5%, 5% each there. At this point in time, and you got Eternal, DMart, Jio Finance, etc., which are also slightly higher. Nilesh Bhai is with us, and we've been sort of talking tariffs and markets with him. Nilesh Bhai, you think we will see a concerted? Thanks for waiting, first of all, and as we took that detour, do you think we need to see and we will see a little bit of pump priming from the government? Do we have space for that? Nilesh Bhai, especially on GST rationalization, RBI is already really behind growth in a big way over the last, since the new governor took over. What's your sense?
So on the monetary policy side, both in terms of rates and liquidity, enough action has been taken. Now, on the rate side, there is still room because this year inflation is expected to remain lower. On the other end, on the fiscal side, we have a lot of space, but we are committed to fiscal discipline. So my recommendation will be, let's give GST cut or any other support which is required and balance it through divestment or asset monetization. There is still room for both divestment and asset monetization at current level of liquidity and market, and that should be used to support the domestic growth. But apart from those short-term measures, what we really need is encouraging local industry through improving ease of doing business. We have taken many steps to improve ease of doing business, but that animal spirit is still missing in private investment. We have to sit with private investors and listen to them about their issues. Some things could be related at state and local level. Something could be related to local purchases. Something could be related to new age industry. Essentially, we need to accelerate growth supporting policies through improving ease of doing business as a medium to long-term answer.
Nilesh, so before we let you go back to your usual business today, that's the question. I mean, so mutual funds have been the biggest support for this market. You expect on days like today, there would be big buying. And, how are they looking at it? Because there's always that debate that foreigners are selling, saying valuations are high and, earnings are not coming through. But domestic MFs, because they're getting the money, they're simply going out and buying. Of course, latest MF regulations could look at changing that. You don't have to buy if you have a lot of money. But more on that later. But just now for today and next couple of days, what do you expect?
And what's the liquidity position, Nilesh, if you could help us out?
So, Nigel, we have reasonable liquidity in terms of cash. Average balance will be between 3 to 5%. Second, we also have asset allocation fund and balance advantage fund, which can increase equity as and when market or valuation starts coming down. So collectively, anywhere between 200,000 crore to 300,000 crore could be potential liquidity with domestic investors. More importantly, we are not here to support the market. We are here to make money. When there is so much of uncertainty, will we be aggressive buyers? Answer is no. We will wait for prices to settle and then build position. So clearly, we will be a buyer, but we will buy where we believe valuations are in our favor. Foreigners invested from the mid-90s, they have made money and hence they are booking profit. We were a little late in accumulating Indian growth story and domestic investors are buying now. Now our collective ownership exceeds foreign ownership. More importantly, it is also time differential. We are long-term investors. Many foreigners are probably taking a shorter-term call. So at the end of the day, if prices go up, both domestic and foreign investors will benefit.
Okay, all right. Nilesh, thanks a lot for joining in. I always take your advice very seriously. And as I always tell you, I'm keeping the faith. So as you said, time to look at it for the longer term. Appreciate you joining in and giving us your comments. That said, let's get in Anand Shah, Chief Investment Officer, PMS and AIF at ICICI Prudential, who joins in. Hi, Anand. Good morning. Not the best morning, right? Because India was hoping a few months ago that we were off the blocks in a flash and maybe we get a favorable deal. That's not come about. But if you look at the reaction, initial reaction, it's not too bad, actually. What's your view? Do you think the street was sensing that this is going to be, a bit tricky, and that's why we have already pulled back close to 4% in the last month, and we were already underperforming what global equity markets were doing?
Hi, very good morning. And yes, to that extent, this is not completely unexpected. The negotiations have been going on for quite a while, and this is what it is. The way I look at it, to me, now we know what's the worst case scenario, be it at a economy level, at individual sector levels, or at individual company levels. We know what is the worst that can happen. All said and done, these tariffs are disruptive in a massive way for all the industries and all the companies in all the countries who are in a way trading with US. And to that extent, it's no different for the Indian companies also. The good news is that India, in that sense, is not that much export-oriented. It's not been that successful in exporting lots of goods into the US market. And to that extent, the overall impact on the Indian economy and Indian markets would be much smaller than what it otherwise would have been for any of our neighbors who have significant reliance on US exports for their own GDP and growth.
Hi, Anand, great to have you on. I want to talk to you about pharma, right? Because pharma actually has been very resilient in all of this topsy-turvy environment. The pharma index is up about 6-7% so far this year. Individual stocks have done more. But there is that sword looming on pharma as well. God knows what happens next. How are you positioned on the sector?
So again, not only pharma, if you see the overall exports basket of India, again, it's not that we are making either supernormal profits in many of the sectors that we are participating, like textiles and others, or we have a significant competitive edge, which is the case with pharma. So to me, I think the expected impact of the tariff on overall exports from India would be far more muted than what we believe or what the market believes can happen because of that tariff. I think overall, if you see the tariffs as a whole, eventually it will be borne by either companies which are making supernormal profit, either in US or outside US. So either it's manufacturer or retailer. But if that's not the case, if the market's not been very efficient and companies are not making supernormal profit, eventually the consumers in US, which is going to pay the price for that. And that's no different for pharmaceuticals also. So to me, that's not today the case. They have exempted pharma for the time being. And to that extent, that's not under debate today. But I'm saying generally, it's not that India has exports where the margins are very high. And to that extent, we will have to absorb some of the tariffs. I think a lot of tariff eventually will be absorbed by the consumers in US.
All right. Anand, since the global space is in a bit of a flux, a lot of focus on the domestic themes. If you were to pick up that one domestic theme that you like, which one would it be? Give and take everything, give and take things are going to improve from here on. What would that sector be?
So I think India is significantly domestic, and within that, there is consumption of goods and there's a consumption of services. India is, as the per capita income grows, services consumption is becoming increasingly larger pie of the overall consumption piece. So say pre-2000, we would have been 65% consumption of goods, 35% consumption of services. As we speak today, it would be like 50% consumption of goods and 50% consumption of services. So I think one piece which we have been closely watching and we've been sort of invested also is the consumer services business, be it telecom, be it healthcare, be it transportation services, be it entertainment services, be it financial services, wealth management. Those are the areas where incrementally the Indian household is spending or / investing in those areas.
But Anand, with the equity market being so ranged, isn't there a bit of a near-term threat maybe to some of these capital market businesses? They've done really well, right? Those who managed to ride the wave, they've made a lot of money. But now within capital markets, if you have to take long-term bets in the portfolio, would you be with exchanges, with wealth managers, with asset managers? What parts of it?
No, indeed, these are all plays on capital markets. And as you rightly said, they will have a higher beta to the overall economy and the markets than what otherwise the rest of the sectors would have. Having said that, I think markets have been expensive for a while now, and we've been all along talking about it. So I think from investors' point of view, I think they need to brace for, notwithstanding the tariff thing, you need to brace for corrections in the market as it is, given we had a very, very sharp fall from October to Feb, and equally sharp rally from Feb end to June end. So I think overall economy is slow. It's known. This tariff uncertainty has further put pressure globally on the global growth, on the US growth, on the China growth, and that's also impacting. I think the first step in terms of monetary easing is there. I think we need to continuously focus on improving domestic consumption, and I think the lower interest rates and higher liquidity in this banking system.
Sure.
Credit growth pick up and a little bit of a domestic growth pick up.
Okay, so keeping the faith on the capital markets side of the market itself, businesses, we'll take that on board and, remember that one. Thank you very much, Anand, for joining in on what's been a very, very news-heavy morning for us over here. Markets all right. Markets been, holding with a cut of about 0.6%, so not too much of a wider fall. Well, let's welcome in Neelkant Mishra, Chief Economist at Axis Bank now, and also the Head of Global Research at Axis Capital. Neelkant, great to have you on this morning. So it's just feeling worse, right? Because everybody's gotten this 15% deal, including South Korea this morning, and we've been handed out 25% plus, quote-unquote penalties for doing business with Russia. Let's talk numbers first. I mean, numerically, what is your assessment in terms of GDP hit? And then what could be the second order effect? Because this seems to indicate that there is maybe a reset in the relationship equation. Maybe yes, maybe no. But your first thoughts?
Okay, so let's first quantify it. So the tariffs paid by Indian exporters when they entered the US market before April was about $2.3 billion. As the 10% tariffs came in April, and then there was a 50% for all steel coming into the US starting June, the numbers had gone up to about $8 billion. So that 2.3 had become about 8. If 25% sticks, then we will be at $18 billion. So there is a $10 billion extra impact. If you were at 15, the number would have been 12. So basically you would have been, so we're talking about an increase of about $6 billion a year on last year's export numbers. And clearly now, I think, as you said, the second order impact on what happens to electronics exports, what happens to apparel exports, there was a lot of expectation that we may have an advantage at these prices or these rates. We may have a 5% disadvantage. Some of this, if these indeed stick, see, I think the message here is that even South Korea was threatened at 25%, but they ended up at 15. So maybe this is the preliminary, the pre-final step to the final tariff. And in a way, I read it as that 15% would be pretty much the floor, 25% now seems to be the ceiling. We will see the penalty, which I think is more sophisticated geopolitics, but that would be the range in which we end up settling. And I don't think it's very substantial. I don't think this is very important from a macro perspective.
Neelkant, I'm so sorry I'm butting in because this ties in with the second part of my question, that the number and the tariff is one piece, but look at the commentary, and this is the latest quote coming in from Mr. Trump. We'll put it out. There we go. The flashes are on the screen, and look at the language. He's saying, I don't care what India does with Russia. They can take their dead economies down together. These are words from the US president. We have done very little business with India. Their tariffs are too high, among the highest in the world. Likewise, Russia and the USA do almost no business together. Let's keep it that way. I mean, these are really strong statements. You know, maybe this is rhetoric, maybe this is more pressure tactics, but that's what it is.
It's midnight in Washington, D.C. I mean, I think we should just ignore it. I mean, it means nothing, really, right? I mean, maybe it's just somebody's asked him something. We don't know what was asked. Maybe he's irritated, you just, back to sleep.
Irritated?
No, I'm not joking. I'm serious.
I mean, I
don't think, look at all the other statements which have come from President Trump, right? I mean, everything has started with India is a friend, Prime Minister Modi is a friend, etc. Of course, the tariffs are a different business, but I think we should just take it off. There's no real reason for us to sort of focus on this statement per se in that sense.
No, but Prashant, I mean, for the sake of a healthy debate, I mean, I just put the other point of view, and that's the question that I was actually, let's ask Neelkant this. That a lot of this, maybe it's just rhetoric, maybe it's pressure tactics, Neelkant. Tell us what you think it is. But would this make investors, stand up and take note that these were these two great countries coming together to do business, but now there seem to be fissures on us buying Russian oil, us buying Russian defense equipment, us not yet saying yes to the F-35s. Is this a bigger reset? And then if yes, do markets need to be concerned?
I don't think so. What I think the markets need to get used to is what they say in diplomatic speak, an absence of binaries. That most relationships, I think, in the next decade, 2 decades, are likely to be quite complex. The thawing of relationships between India and China, for example, is also a very meaningful development that has happened. So on the one hand, I think the strategic competition with China remains intact, but at the same time, there is an access to our markets that we can provide and on our terms in return for their technology and their capital. Similarly, with the US, I mean, the headlines in today's papers, you would have seen, on the one hand, there was a 25% tariffs, and right next to that was the launch of NISAR, which is ISRO and NASA launching together. And from what I understand, there are very deep-rooted connections between India and the US. This is, we have to put this thing in perspective, that there is a $6 billion impact. I don't want to underestimate or emphasize that, this is nothing at all. There is an impact. There will be an impact on apparel. There will be an impact on jewelry. There will be an impact on electronics. But again, this is something that India needs to counter through maybe fiscal support measures, through other regulatory measures. Because what India, and if you see the Indian press release, it very clearly states that, look, we have limited room for maneuver on the agri side. I think that one of the issues not stated in the press release that even if we cut duties, the impact has to be graded, meaning over a period of time, it cannot be sudden. And those are things that India is unwilling to negotiate. Now, can there be other grounds on which common ground can be found? Perhaps yes, but I would not interpret this as a complete break of relationships because these are strategic partnerships. President Trump is still coming in October for the Quad Summit. So, at this stage, I think the market should be best off just thinking about it as a $6 billion impact. And let's see where the negotiations go next.
Okay, all right. Hi, Nilkant. Good to see you, Ben. What about flows? The other worry is we can quibble about, what's going to happen with regard to duties, whether or not it'll be lower or not. But the fear is that as it is, we were not getting a large chunk of the FI flows. And now, in fact, because of this sort of engagement that we're having in the United States, maybe that further moves away. What's your take with regard to flows?
Again, we have to think about individuals looking at their own self-interest. And so investors have to see India for where we are. If a very significant amount of monetary easing has happened, as of now, the economic momentum is quite weak, which perhaps is still weakening. But with the extent of monetary easing, the economy should revive. Now, on the flow side, we've been studying this every month. And frankly, India is not an outlier. So over the last 12 months, if you see flows as a percentage of market cap, India is somewhere between 1 and 3. And, the country that has got the second most, China. So if you think that US and China are somehow becoming friendlier, they're not. This is a contested relationship. It's a complex relationship. And therefore, I would not think that the flows beyond maybe 1 or 2 days here and there would actually be affected substantially. They will be much more affected if the monetary easing that has been pushed out pushed by the Reserve Bank and the Monetary Policy Committee does not result in meaningful credit growth in the next 6 months. For me, the fact that the real estate cycle is stalling, that for me is a much, much more important variable than, tweets. And frankly, it's not even a letter yet. It is, I think, this is like the semi-final, pre-final that, it is stalling. Let me put some pressure. Let's get people to start, finalizing quickly.
I got it. All right. So $6 billion in terms of increased tariffs, not too concerned about flows. It's not an India-specific issue. So we got that out of the way. But you spoke about monetary policy. And now the hope is there could be some easing. What kind of action are you factoring in from the RBI? Because clearly the economy, the most data points, you get power, other consumption data points as well. It's soft. As of now, it's soft. The hope is from September onwards, we see a recovery. What role does the RBI have to play in this?
Okay. I'll take a minute to answer this. If you think about a 7% potential growth rate, you have cyclical factors on the fiscal and monetary side. In the last 2 years, as the government was doing fiscal consolidation by 80 basis points each, and it is 40 basis points this year, you are effectively starting. I know I'm oversimplifying, but I think it's very useful to think at a framework level. Your potential growth is 7, but if the government is shrinking the fiscal deficit by 80 basis points, you were starting at 6.2 in the last 2 years. This year, you're starting at 6.6. Then there is a monetary overlay. In March 2024, credit growth adjusted for the big merger that happened was 16.3%. It became 12% in March 25 and 9.8% in May 25. So there is a 6.5 percentage point decline in credit growth. Now, given that banking system credit is about 56% of GDP, this is a more than 3% of GDP impact that we have seen because of monetary tightening. Some of it, I think, was intended. Some of it was absolutely unintended. I think the RBI ended up using very blunt tools last year, which has resulted in some of these problems. So the economy, as we speak, I think your read is right, is still weak. In fact, it may still be decelerating. When monetary easing happens, the channel through which it is most potent in India is credit allocation, meaning that financial firms need to get the risk appetite to start taking on more credit risk. As the economy is decelerating, it becomes harder and harder to do that. But still, given the extent of the easing, I think it's a reasonable assumption that there are some financial firms which still have the balance sheet, they don't have the NPAs, they can start pushing through. And once the first 1% point increase in credit growth starts to happen, which is, I think, maybe November, December timeframe, the economic acceleration after that should be quite substantial and very, very rapid. That's our opinion.
That sounds very, very reassuring, just the kind of reassurance perhaps one needs, Neelkant. And, I was just coming to exactly that point. So you're saying October, November onwards, the acceleration should pick up. So let's just, understand what you're baking in right now. How many more rate cuts? What kind of a pickup in GDP growth? And are you factoring in anything more from the fiscal side? We've already got that income tax cut. Is there anything else that you would expect or, at least wish that the government considers?
So on the monetary side, see, there is prescription, there is prediction. So prescription for me is that nothing more needs to be done for now. Because remember that the channel through which we are expecting monetary policy to act is not the cost channel. So we are not saying that if you make loans 50 basis points cheaper, credit demand will accelerate. Because the challenge here is risk aversion in the economy, risk aversion in the regulators, risk aversion in the financial system. Just to give you a sense of what I'm saying, back in 2013, nearly 60% of bank loans were at interest rates about 12%. And I totally get that this was a high inflation environment, that things were growing faster and all that. But that was the level of risk. Today, it is less than 11%. In the last 1 year, the incremental share of 10% plus interest rate loans has collapsed. So it is about, so when the problem is risk aversion, I think rate cuts are not going to help. So I think what you need is much more, I would say, procedural changes, and which we can discuss when we have more time. But on the fiscal side, I don't think there is much room. In fact, what I apprehend or what I'm apprehensive of is that in the next couple of months, there may be market concerns emerging that tax collections are falling short. Remember that these things are all very cyclical, they feed on themselves. But hopefully that will be temporary. I don't think the government intends to miss its fiscal target. So if it means there may be more disinvestment, there are other tools available which you can use to sort of meet the targets. And so fiscal, I don't think there is room. I don't think there is even intent to change this. I think the government is likely to wait for the reduced cost of capital, that the 10-year bond yields are low, the equity capital is cheaper, and let entrepreneurs then do their thing. So I don't expect anything to happen, but I do expect that with a lag, the monetary easing should lead to greater credit risk appetite for borrowers. And I think demand is there. I mean, most people say, oh, there is monetary easing, but where is loan demand? In an economy like India, credit demand is always ahead of credit supply. If you see some of the NBFCs lending at 28% viably, it tells you that that the demand for credit is all there. It is a question of when the financial firms and the regulators become much more comfortable allowing firms to take credit risk.
Yeah.
All right, Neelkant, thank you very much for joining us. Good speaking with you. And as you said, we'll invite you over for a longer discussion, but I think very, very useful, very insightful as always. Thanks indeed for being with us here on the program. 140 points lower. Nigel, I think we have the management of KPIT with us.
Well, that's right. Let's focus on that one then, the earnings reaction. KPIT is on our radar. Well, the last quarter's performance is a little bit subdued, but the management is optimistic on growth momentum in the second half of the year. Let's talk more about the past quarter's numbers. Mr. Sachin Tikekar, the joint MD, joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, you're indicating the second half of the year will be good. But do you think quarter two as well, we are bracing for a bit of degrowth? And going that quarter, the first half is going to be soft, second half is going to be better. For the year, give us a rough range in terms of growth. What are you looking at?
Absolutely. First of all, thanks for having me. So first of all, we are happy with the performance of the last quarter. It's in line with our expectations. We were able to hold on to our margins, which is very unusual these days, at 20% EBITDA and more than 17% EBIT. The top line was as expected, and what we are seeing is, first of all, the deal closures have gone up. The pipeline continues to look robust. It's just that there are certain things that are still hanging up there. And hopefully, we've been talking about tariffs and the geopolitical issues and also the intensity of the competition among the OEMs in the car and the truck segments. That part needs to stabilize a little bit. And we believe that in another quarter or so, things will stabilize. Once they stabilize, we think we'll be able to start these engagements that we've been able to sort of seal over the last couple of quarters. So we do believe that H2 is going to be better than H1, especially towards the end of H2, we'll see growth coming back. So that's what I can say about, and it's going to be our effort to hold on to the margins while we go through this kind of transition.
All right, so 21% margins or so is, is something that you can maintain is the takeaway that we're getting. But, if I look at the growth, as you're saying, second half will be good, but should we brace for a degrowth in quarter two as well?
It's we don't talk about quarter-on-quarter numbers. All I can say, given the uncertainty continues, while we continue to start new engagements, there are pressures on the other hand as well. So, given the uncertainty, it's hard to say at this point in time. However, given the actual closures and the pipeline, we feel much better about the H2 of this financial year.
Okay, so when you say much better, can you give some more color on that, Sachin, in terms of what clients are saying, your deal pipeline, size of deals, nature of deals, and the pricing of those deals as well, given that we are in this AI environment?
Absolutely. And, to us, what we've been bracing for last couple of years is moving from being largely a services company to a solutions company. That's something that we started to do a couple of years ago. And now it's getting accelerated. What we have also done is we have created models that are AI infused for mobility, and we are applying those. And with those models, what happens is we take a broader view of a program and sort of cannibalize some of the stuff from our competitors and at times our own business. So that's the kind of transition that we are going through at this point in time. And we believe that this will continue. The name of the game is going to be solutions and products going forward. So we're reimagining our business in some sense. Hence, it's just going to take another couple of quarters for us to make that adjustment. In terms of the wins and the deal pipeline across the three geographies, I think we have had healthy closures from passenger car, trucks, as well as off-highway. Obviously, given our depth and breadth in passenger cars, the volume is much bigger there. But we are seeing some initial shoots, green shoots in trucks and trucks and off-highway as well. One thing I do want to say is there are three countries where we started to make investment. Sweden, where we opened an office recently, and there are a couple of large truck OEMs and one passenger car company. And we have started to focus on India for India and China for China. So we do hope that both India and China also contribute to our growth as we get towards the second half of this year.
We would have had a longer conversation, and we do hope we get the opportunity to speak with you mid-quarter once again. Just a busy day because of tariffs, you would understand. So thank you very much for joining us with your perspective on the business and the lay of the land. HUL numbers are there at the bottom of the screen. 2730 odd crores is what the net profit looks like. 2535 crores was the poll. So 15,930 odd crores is the revenue. 15,945. So these look like absolutely in line with expectation numbers. The EBITDA also almost, there's a 30-40 odd crore difference between the reported EBITDA as compared to the poll. Mangalam should join us in a bit, but I think let's just bring in Naveen Kulkarni for a quick reaction to these numbers. Naveen, if you've seen the basic set, your thoughts?
Yeah, overall, I would say that these numbers look okay to me. There is some bit of contraction in EBITDA margins is what I see, but I think that was expected. Revenue numbers, I think there's a 5% growth for the quarter, which I think looks quite okay. Broadly speaking, I would say that first reaction is kind of inline numbers, but a little bit encouraging that we can see some bit of improvement on sequential basis.
Naveen, what is the volume growth estimate that you have? I mean, if the first quarter started off like this, we were just speaking to Neelkant Mishra of Axis, and he, like many others in the market, believes the second half growth could start picking up. I mean, for HUL, what is your volume estimate and call on the stock?
So volume growth estimates was not much, right? It was very low single digits, right? 1 to 2% kind of volume growth.
For the full year?
No, not for the full year, for the quarter. Full year, I think we should end up, again, it will be low single digits. I don't think so we are going to have a significant number. Second half, it might pick up. So first half, second half, I think it might be in the range of around 4%, 4 to 5%. But again, we'll have to see how that picks up.
So then 4 to 5% volume growth and looking at valuations right now, what's your rating on the stock?
So we don't have a rating as such, but I would say that overall valuations are still not cheap. But of course, it has come off from what it was probably a few years back. If growth numbers pick up, I would say that the valuations will be justified and stock could do well.
Okay. All right, Naveen. Thank you for that. We've got Manglam weighing in as well. Manglam, we're desperately looking for good news. I don't know. Tell us what you think of HUL.
Well, you know, these are largely in-line set of numbers as the street was expecting nearly 3 to 4% sort of revenue growth. The company's gone ahead and reported that as well. There hasn't been a big dent in the EBITDA. In fact, the margins have been largely in line with street expectations of 22 to 23% as well. So 22.3% is what the company's written. The only couple of things that we are awaiting right now are the management commentary and the volume growth. The street was working with this time around a volume growth of anywhere between 3 to 4%, largely in line again with what the company's revenue growth has to be, because they've said that there would be low single-digit sort of price growth that may come by. So that was what the expectations were. And more than anything else, you know, what the way ahead looks like in terms of demand would be extremely crucial to track for HUL, largely because, one, these results are in line, the underlying demand environment is improving. And for HUL itself, come tomorrow, we have a new leader joining in. Priya Nair joins in as Rohit Java steps down today after the board meeting takes place. So we will, you know, await any sort of new strategy coming in from the new leadership out there. But these numbers absolutely in line. The stock obviously has seen a recovery from lows ever since the leadership announcement change was announced.
Okay, yes, absolutely. 3 cheers for Priya and Lady Power at HUL. First time ever in the company's history here in India. Manglam, thanks very much for that. We've got Prakash Diwan joining in for a quick reaction. Prakash, I mean, look at the market environment, look at lever, stock's not done much. There's some anticipation of a turnaround. Is it a buy or is it an avoid for you?
So a couple of things that make it positive. One is the numbers could have been much worse than what they've come out with. This is very much in line, even if volume growth is as anticipated, low single digits. It paves the way, given the input side being so benign and a new leadership, there's continuity, there's a little bit of new energy. And remember, we'll of course wait for the internals, what's contributed to these numbers. But if personal care, hygiene, beauty products, those are the ones that start growing, they usually result into better margin profile as well, while it may not lead to great volume thrust. But so I think it stands at a cusp where things could only look up. It's a great handover for the new leadership to take it forward. So quite positive. But I don't think the market's going to be disappointed or, you know, wanting to sell beyond where it is. Of course, it's still $600 short of the 52-week high. But you know, that doesn't seem very difficult to cross as we progress in the next 9 months of this year.
No, absolutely. By the way, Prakash, the market reaction today, just if you didn't know that this 25% happened, 150 down on the Nifty, could be any other day.
You know, that's what Surabhi said when you started off the market with the heat map. It, you know, 0.5%, 0.6% is par for the course, Prashant. You're absolutely right. And remember, you know, we are such a domestic focused economy now, and growing on all counts. It might not make such a big difference given the volume of exports and just a few sectors being exposed. You know, as long as IT and pharma continue to be out of this, I don't think there's much to worry. It was sentimental. It was the tone of the messaging that was a bit harsh, which made people get a bit anxious. But I don't think the contents are really worth worrying about. So markets will go back to focusing on earnings, which is the right thing to do. And from that perspective, if the last 48 hours have been any indication with L&T and some of these other large numbers coming through M&M, I think we are seeing an earnings season that's shaping out to be much better than what we would have thought at the beginning.
All right, Prakash, thank you very much for that. What we'll do is we'll take a quick commercial break here. Markets are down 150 odd points. We'll come back with the top management at Mahindra & Mahindra to talk about their first quarter numbers, which came out yesterday. Stay tuned. Okay, welcome back. The market's down 160 odd points. So this is, pretty much like, have to say like any other day, 0.6, 0.7 odd percent lower, par for the course. Market breadth, though, is a little negative. 1,800, 1,900 stocks are down, and you've got about 600 odd names which are in the green. So about 3:1 is where declines to advances stands right now. As promised, we have Mahindra & Mahindra's top boss with us. They reported, of course, M&M reported numbers yesterday. Healthy volumes, revenue growth, but margins were impacted by, maybe a little higher proportion of EV sales. Anish Shah is Group Chief Executive Officer and Managing Director at the Mahindra Group. Anish, great to have you with us here. It's always a pleasure.
Likewise.
To have you in the studios. We'll get to the numbers in just a bit, but I have to address what is top of mind this morning, which is tariffs. Now, auto OEMs, in terms of exports to the US, is very small. So in terms of the direct impact, it's not very much. I'm not asking for a Mahindra company impact. But as a leader of the industry, Anish, auto ancillaries is there are large exports into the US markets. How disruptive is this, and how do you think about it? Because when we started all of this in March and April, at a broader level, the expectation was that we probably will end up with a lower tariff compared to peers, countries around the region, etc. We're actually on the other side now. Most are at 15, 20, we're at 25 plus. Your thoughts?
The story is not over as yet. I think there's a lot to be done. And based on what we've seen our government be very balanced. There's a good relationship between both countries. So I think everything will work out well.
You think these will be negotiated lower? Or
I think we're still a little ways away from the end state. So I'm very positive that things will work out well.
Specifically with regards to auto ancillary companies, any thoughts at all at a broad level?
I think it's still too early to say. I think we just have to wait to see how this progresses. We have to do what's right for the country overall, and I think that is what the government is doing. So I do feel that things will work out well. As I look at the UK FTA, I think that has been brilliantly done.
Yes.
It's a great win-win, and it's one that positions us very well on the world stage. And there are others that are in the pipeline as well.
So that's on tariffs, and fingers crossed, keeping the faith, like you're saying, picture abhi baki hai. Maybe that's how it's going to be, and 25% will not be the ultimate levy that we'll get. Now let's talk about the performance. And Mr. Shah, it's been superlative once again. Good volumes. The profit growth is, 30% plus. The revenue growth is 26%. But I want to come to the more challenging part, right? Because that's what the market always looks at, because your stock has done so well, and that's margins. Now, people will want to understand that as, the share of EVs keeps rising in your mix, and those cars are selling so well, right? What is the trajectory for margins for your automotive business?
So any new launch has lower margins, and that's what we've seen over time. And no difference here from an EV standpoint. With EV, it gets a little accentuated because we have 6 launches with one platform coming in with EV. And we have been showing the difference in margins for ICE and EV right now. Our ICE margins continue to be very healthy and very strong. And on the EV side, as volume grows, we will see that catching up. Volumes will grow over the next couple of years. And we feel that margins will be at par with ICE. And that's something that we have to demonstrate, as we have with all of our previous launches.
So just to put some numbers to that, ICE as things stand, as commodity costs stand, and competitive intensity stands, where do you see ICE margins by the end of the year? And where will the EV margins be? Or if not EV specifically, where would then blended margins be for autos?
So we've stayed away from any forecasts on margins. Our ICE margins were much lower 2 or 3 years ago. I know there was a lot of questions when the XEV700 was launched because the margins were lower when that was launched as well. And at that point, we had deviated and given a forecast saying we will grow 300 basis points in the next 18 months or so. And we beat that handily and have grown much more since then. So we are in a very good position. My sense is we are probably the market leaders or close to it in terms of margins. And we will continue to focus on growth in margins, but more important for us is overall growth. And that is what you've seen us deliver. Our capacity has gone up 4x now in the last few years. And we continue to add capacity. And we continue to see very strong performance across each of our brands. In a flat or close to flat market, we've grown 22% this quarter. And market share is up 5.7 percentage points. That's something that typically is well beyond what we've seen anywhere.
But can we say that near about 14%, which is where your EBITDA margins are at the start of the year, first quarter, is that a floor? Or could the flux and the changes in the mix, could it take it lower before it recovers?
In the world we live in today, I can never say something's a floor because we will always have some challenges. Okay. What we have learned is we get back from the challenges quickly enough and we come back. So I would look at it as a good margin for us. We will strive to continue to increasing it. We would love for that to be a floor. But the world we live in today, that may not always be a luxury.
All right. And, beautiful to see those Mahindra vehicles on the road look absolutely splendid. That said, let's focus on the other part of your business, the tractors business. It went through a bit of a lull, I think, 18 months or so ago. But the tractor industry itself is looking up and you have been gaining market share. What kind of a growth number could you give us in the tractors vertical? And your market share has already improved. Do you see further scope for improvement from here?
So industry has grown. Our volume is up 10% this quarter. You're right, our market share has grown very well. We are at 45.2%. On tractors, I would look at it slightly differently. At a 45% market share, our message to our teams is we are not going to focus on market share growth. We're going to focus on execution. That has been our message for the last 5 years. And we've gone from 40 to 45%, driven by strong operating excellence in what we do. And that is the approach to market share growth there. It is product, it's operational excellence. And that has worked very well for us.
Okay. All right. Mr. Shah, final question before we let you go. And I need to ask you this because we get asked this query quite often. Is there any kind of value unlocking exercise in the works? Would you consider demerging both these two businesses since both of them are flourishing now, both of them are growing at a good pace? Is that on the cards sometime in FY26 or FY27?
So this has been a question I've been asked for the last 5 years. And 5 years ago, I said, we're going to first focus on operating very well.
Yes.
And that will be the value unlock. We've grown our market cap 12x from April 2nd, 2020. And that has been hopefully a good value unlock. We still feel we have the ability to continue on that path of operating well, being able to grow. And all of this has been organic so far.
Right.
It has not even been driven by acquisitions. We will likely look at acquisitions, but we will look at it where we can significantly grow one of our current businesses, or we find some amazing opportunity that we feel we can deliver returns with. Because what I also want to highlight is a performance you see now, and you've seen that consistently for multiple quarters, is driven by all our businesses.
Yeah.
And we talk a lot about auto because it is a very exciting business.
Yes.
But Mahindra Finance, TechM, Life Spaces, logistics coming back very strongly now, holidays, Sustain, Excello, all of these businesses are contributing very well to our growth number. And that is what's delivering the value unlock.
So no demerger.
No demerger. We are hearing no demerger.
No demerger.
Is nothing for now.
For now.
You said you've been asked this.
Nothing for now. Yes, we will always look at value creation for shareholders. So it is never off the table. But as I said 5 years ago, we're going to first focus on what value we see today.
Yes.
And then we will evaluate what.
So in the near term, it's not on the table, but maybe we'll have to see how things unfold.
You spoke about, I asked you this question 2 or 3 quarters back, and you said, you turned the question on its head. You said there's a conglomerate premium perhaps, not a discount.
We are starting to see it head that way, right? Because we are starting to see analysts recognize the fact that businesses being together can actually add more value. And that is what also, you're right, I've said this before, which is we will evaluate very carefully what is the value of keeping them together versus separate. Right? Our focus is on shareholder value creation. But we do believe that there's greater value in many ways of keeping them together, and that's what we've seen. So that's part of the exercise we will do at some point in future, not in the near future, possibly not in the medium term as well, but at some point.
And we'll keep asking you every quarter, maybe. We'll be nearer, but we'll see.
When my response is mistaken, at least.
So just a broader question. We've been, again, this is not new, but has consumption maxed out? That's been a question, even at the premium end. I mean, we've asked that question, but as your sales, SUV sales have shown over the last many years, clearly that has not been the case. But I'm asking again, are you starting to see a little bit of that, maybe?
In fact, very much the contrary in our view, because if you look at almost any metric, penetration of products in India is far lower than anywhere in the world. And India is growing as an economy. Yes, we will see some bumps along the way, as that will always happen. But rural's come back very well. Urban is slower right now. And I would expect the second half of the year for India to be a very strong second half.
For your business as well?
For the economy overall.
And but for your business as well?
For our business, I always expect the next quarter to be very good.
You just need to be at one of those Mahindra showrooms, and I was at one a couple of months back to realize there's no slowdown in India. But very quickly, you mentioned acquisitions. So is there anything cooking in the kitchen right now? Which segments, what size, geographies?
We are always cooking in the kitchen. And we look at anything that might help our current businesses position themselves much better. SML was a specific example on that front. But we have a very high bar. And we will do things only if they are accretive, if they make sense, if they will really add value for us as well.
All right, Manish, thank you so much once again for dropping by. And it's always a pleasure chatting with you face to face. Really appreciate it. Good luck.
Thank you.
Thank you.
Well, I think that is the sort of view coming from the top as far as the Mahindra Group is concerned. 360-degree view. I mean, we started with tariffs really at the top, and then, of course, micro with regards to the business itself, and rounded it off with that, value unlocking a question as well. We'll take a quick commercial break here. We're going to come back more on markets on the other side. Stay tuned.
Welcome back. The equity market is still dealing with a cut of about 0.75%. Let's shift focus to commodities, see what's brewing there. Manisha is joining in with the latest. Good morning, Manisha.
Well, every segment and sector in commodities brewing, but I have to choose one. So I'm talking about the crude oil prices right now. And we are trading at around 6-week highs onto this one. If you look at the month of July, this has been the biggest monthly gain since September 2023 that crude is posting out. And that is by, again, up of around nearly 10% for the month of July there. Well, the US has announced tax on Indian exports, and that's something the markets are looking at. There also is penalty for Russia oil imports. There also has been conversation about China here. So the concerns really come in right now is that India and China, because they are the exporters of refined crude, is what you could be looking at in shortage in the international markets there. Also, Russia is the top oil suppliers to India, with the kind of reports that are available right now do suggest that in first half of 2025, 35% of the overall oil supplies to India came in from Russia. So that's a significant number there, and that's exactly what the markets are reacting to as well. So as I said, there are concerns about refined product exports from, like diesel, from India and from China as well, and that immediate tight supply is what is keeping the markets in good favor there. Also talk about the US introducing very extensive sanctions on Iran, the highest and the most intensive, as I said, in last 7 years is what we're dealing with right now. And of the 20 companies who have been put in these sanctions, 6 of them really are in the Indian markets. There companies that have been targeted also are in Turkey, in China, Indonesia and UAE as well. So US has imposed sanctions on trading in many of these companies which are into petroleum and petrochemicals as well. All assets of these companies in US are to be frozen, and if there are US entities a part of these companies, that also will go into a freeze there. So well, US entities are prohibited to conduct businesses with any of these companies also. And interestingly, many of these Indian companies, and that should come on your screens really, have imported commodities like methanol, toluene and polyethylene from Iran. Most of these companies also are into supplying and trading. Not too many of them are listed as well. And when you look at those names and those numbers and the kind of period and the imports that we've seen from Iran, clearly have been on the higher side. But as I said, it's not directly crude. It is to do with crude products there. And we are looking at 84 million or 51, 49. And these really are the company names that have been put out by US as well. If you look at many of these companies, the numbers are for 2024. And many of these are from October to Jan 2025 as well. And it has been millions of dollars, but the markets do believe that at this point in time, there's not going to be a very large impact because the quantum overall is on the lower side there. Apart from that, we haven't heard from these companies yet. And there is an addition in that statement that came in from US suggesting that these companies have the ability to appeal to be taken off those sanction lists. They will, of course, have to give various documentations and future accountability as well. So at this point in time, not too much of an impact, but we have those numbers coming in on your screens there. What the markets also will watch out for is the OPEC Plus meeting on this weekend. As of now, the conversation is that while OPEC has been increasing production from the month of May until September, October actually could be a bit of a pause there. The strength in dollar index is what seems to be weighing onto the markets right now. But even with that, $73 per barrel is holding for the Brent prices, with markets believing that even as July is ending 10% on the higher side, August could be equally bullish.
Okay, all right, got it. Thanks very much for that. Manisha there with the commodity cues. By the way, just let's fire up the HUL intraday chart if we can. That commentary has really sparked off lots of buying. They're saying sequentially margins can improve. And if commodity prices remain benign, then they're talking about some price growth as well. And the market loves the sound of that. It's almost 2.5% up on HUL. Well, with that, we'll take a quick break. On the other side, Lata, comes in and she discusses the impact of this 25% tariff on India. If these tariffs stick, then how big a hit will it be for the Indian economy? She'll be in conversation with Ajay Srivastava of Global Trade Research Initiative and Abhishek Upadhyay, Senior Economist at ICICI Securities PD.